There's a financial game being played and almost everyone is losing without realizing they're playing. The rules are simple but invisible to those who weren't taught them. Hold cash and watch inflation silently steal your purchasing power, earn income through wages and pay the highest tax rates on it, save prudently in bank accounts that guarantee real losses after inflation, invest conventionally in retirement accounts you can't touch for decades while fees compound, and follow all the rules about financial responsibility that were designed to keep you trapped in the system working until you're too old to enjoy freedom. This is the money trap, and it's sprung on hundreds of millions of people who believe they're being financially responsible while actually guaranteeing they'll never build significant wealth. But there's another game happening simultaneously, one played by the wealthy using completely different rules that most people don't even know exist. The wealthy don't hold cash beyond operational needs because they understand currency is a melting ice cube losing value daily. They don't earn income through wages taxed at the highest rates. They structure compensation as capital gains, stock options, and carried interest taxed at half the rate or less. They don't save in bank accounts, they borrow against appreciating assets at interest rates below inflation, effectively being paid to take debt while their assets compound. They don't invest in their home country only, they diversify globally so no single government's policies can destroy their wealth. And most importantly, they don't follow the conventional wisdom about financial responsibility because that wisdom was designed to keep ordinary people poor while making the system that exploits them appear fair and meritocratic. Understanding how the rich escape the money trap means recognizing that wealth isn't built by working hard and saving prudently in a system designed to transfer wealth upward through inflation, taxation, and financial repression. It's built by understanding the real rules, structuring your financial life to avoid the traps, and using the same strategies the wealthy use to preserve and compound wealth across generations while everyone else spends lifetimes running in place on a treadmill going nowhere. The first and most fundamental way the wealthy escape the money trap is by never holding significant cash. As detailed in previous scripts, inflation is a tax on cash holdings that destroys purchasing power continuously at rates of 2 to 3% in normal times and much higher during crisis periods. A middle-class family keeping $50,000 in savings accounts earning 0.5% interest loses roughly $1,000 annually in real purchasing power at 2.5% inflation. Over 20 years, that $50,000 becomes worth about $31,000 in today's purchasing power. The family thinks they're being prudent and responsible by saving. They're actually watching their wealth melt away. The wealthy understand this implicitly and structure their finances accordingly. They hold minimal cash, typically only enough for a few months of expenses, plus some opportunistic dry powder for buying assets during market dislocations. The rest of their wealth is in appreciating assets: stocks, real estate, businesses, commodities, artwork, anything that holds value or increases with inflation rather than being destroyed by it. These assets don't just protect against inflation, they often appreciate faster than inflation, compounding wealth rather than destroying it. Real estate is the classic inflation hedge, and the wealthy own disproportionate amounts of it. When inflation runs at 3%, rents typically rise at similar or faster rates because landlords pass increased costs to tenants. Property values rise as replacement costs increase. A property purchased for $1 million that appreciates at 4% annually is worth $1.48 million after 10 years, outpacing 3% inflation and preserving real purchasing power while generating rental income throughout. Compare this to $1 million held in savings accounts that becomes worth $740,000 in real terms after the same period, even with modest interest. But the wealthy take this further through leverage. Instead of buying one $1 million property with cash, they might put down $200,000 and finance $800,000 at, say, 4% interest. If the property appreciates at 4% annually, the value rises by $40,000 the first year while the mortgage interest costs $32,000. The net appreciation is $8,000 on $200,000 invested, a 4% cash-on-cash return, plus the benefit of renters paying down the mortgage principal. Over time, as rents increase with inflation, the cash flow improves while the mortgage payment remains fixed. The real debt burden decreases through inflation while the asset appreciates nominally, creating enormous wealth through leverage. This leverage strategy is unavailable or unwise for most people. Someone without substantial assets can't get favorable financing terms. Someone living paycheck to paycheck can't absorb the risks of vacancy or tenant defaults. And someone without financial sophistication might not understand the risks of leverage during market downturns when property values can decline while debt remains. But for the wealthy with resources and knowledge, leveraged real estate is a primary mechanism for converting inflation from enemy to ally. Stocks and businesses provide similar inflation protection because companies can raise prices when their costs increase, passing inflation to customers and maintaining real profit margins. A company earning $100 million in profit today will likely earn more in nominal terms a decade from now because it can adjust pricing. The stock value tracks this nominal profit growth, protecting shareholders from inflation. Dividends grow over time, providing income that rises with inflation rather than being fixed like bond coupons or pension payments. The wealthy concentrate their holdings in productive assets that throw off income and appreciate over time. Warren Buffett's Berkshire Hathaway doesn't hold billions in cash despite having billions in assets. It holds stocks in businesses, entire operating companies, and income-generating investments. When Buffett does accumulate cash, it's positioned opportunistically to buy assets during market dislocations at distressed prices, not to save in any conventional sense. Commodities, particularly precious metals like gold, are another inflation hedge the wealthy use. Gold has maintained purchasing power across millennia while every paper currency has eventually failed. An ounce of gold that bought a fine men's suit in ancient Rome still buys a fine suit today. The dollar amount fluctuates, but the real value remains relatively stable. The wealthy typically hold 5 to 15% of portfolios in gold or other commodities as insurance against currency collapse or extreme inflation, knowing that when paper assets are destroyed, hard commodities retain value. The second major way the wealthy escape the money trap is through the tax code's systematic preference for capital over labor. Ordinary workers earn wages or salaries taxed at ordinary income rates that can exceed 40% federally plus state taxes. A worker earning $200,000 annually might pay $70,000 or more in federal and state income taxes plus payroll taxes for Social Security and Medicare. Their effective tax rate on earned income approaches 40–45% in high-tax states. The wealthy structure compensation and income to avoid these high rates. Capital gains, the profit from selling appreciated assets, are taxed at preferential rates of percent, 15%, or 20%, depending on income level, far below ordinary income rates. Qualified dividends receive the same preferential treatment. And crucially, unrealized gains, the appreciation of assets you haven't sold, aren't taxed at all, regardless of how much wealth has accumulated. This creates the buy, borrow, die strategy that USC law professor Ed McCaffrey identified as the core mechanism of how the ultra-wealthy avoid taxes. The strategy is simple. Buy appreciating assets like stocks or real estate, borrow against them when you need cash rather than selling them, live on borrowed money that isn't taxed because debt isn't income, and when you die, your heirs receive the assets with a stepped-up basis that eliminates all capital gains tax on the appreciation. Here's how it works in practice. A billionaire owns $1 billion in stock that originally cost $100 million. The unrealized gain is $900 million. If they sold the stock, they'd owe roughly $200 million in capital gains tax. Instead, they borrow $200 million from a bank using the stock as collateral. The loan isn't taxable income because it's debt that must be repaid. The interest rate might be 3–4% on such a secured loan, costing $6 to $8 million annually. But the stock portfolio likely generates dividends and appreciation exceeding that interest cost, and the interest is potentially tax-deductible, further reducing the effective cost. When the billionaire dies, their heirs inherit the stock at its current market value of $1 billion with a stepped-up basis, meaning the cost basis for tax purposes becomes $1 billion rather than the original $100 million. The $900 million in appreciation is never taxed. The heirs can sell the stock immediately and owe no capital gains tax because their basis equals the current value. Or they can continue the strategy, borrowing against the appreciated assets and passing them to the next generation with another stepped-up basis, perpetuating tax-free wealth transfer across generations. This strategy is completely legal and is used by virtually every ultra-wealthy family. It's why Warren Buffett, with a net worth exceeding $100 billion, can have an effective tax rate lower than his secretaries. His wealth is in Berkshire Hathaway stock he's never sold, generating no capital gains. He lives modestly and borrows when necessary rather than selling. His wealth compounds tax-free until he dies, at which point his foundation and heirs will receive it with stepped-up basis. The stepped-up basis at death is arguably the single most valuable tax provision for the wealthy and one of the most regressive features of the tax code. It means that all capital gains accumulated during a lifetime can pass tax-free to heirs if the asset is never sold. A working-class person who saves $100,000 over a lifetime pays taxes on every dollar earned before saving it. A billionaire who accumulates $100 billion through stock appreciation pays no tax on that gain if they never sell and passes it to heirs who can sell it tax-free. This provision alone transfers billions from the Treasury to wealthy families annually. The third escape mechanism is access to credit at favorable terms that allow leverage to multiply returns. The wealthy can borrow against assets at prime rates or lower, often 4 to 5%, because they're secured by valuable collateral and the borrower has established creditworthiness. When inflation runs higher than the borrowing rate, the real cost of debt is negative. You're being paid in real terms to borrow because the debt is repaid in depreciated future dollars. A simplified example, borrow $1 million at 4% interest. If inflation runs at 5%, the real cost of the debt declines by 1% annually. After 10 years of 5% inflation, that $1 million debt is worth only $614,000 in today's purchasing power. You repaid the loan with dollars worth 39% less than when you borrowed them. Meanwhile, if you invested the borrowed $1 million in assets that appreciated at 7% annually, you turned $1 million borrowed into $1.97 million in value, nearly doubling your money with someone else's capital. This leverage amplification is how real estate fortunes are built and how the wealthy compound returns. A 7% return on owned assets is good. A 7% return on borrowed money at 4% cost is a 3% spread that creates enormous wealth when multiplied by tens or hundreds of millions in leverage. But access to this leverage requires assets to borrow against and creditworthiness that most people lack, making it an escape route available primarily to those who already have wealth. The fourth mechanism is international diversification that protects against single government policy risk. The wealthy don't keep all assets in one country subject to that government's taxation, regulation, and currency policy. They diversify across jurisdictions, holding assets in multiple countries, using offshore structures for asset protection, and maintaining multiple residencies or citizenships to preserve options if conditions deteriorate in any single location. This geographic diversification protects against currency collapse in any single nation. If the dollar crashes, assets held in euros, Swiss francs, or Singapore dollars maintain value. If U.S. taxes become confiscatory, assets held in offshore trusts or foreign entities may be protected, at least partially. And if political instability threatens, multiple citizenships and foreign property provide exit options. The infrastructure for this diversification includes offshore bank accounts in Switzerland, Singapore, or the Cayman Islands. Shell companies in favorable jurisdictions like Delaware, British Virgin Islands, or Panama. Trusts established under favorable trust law in South Dakota or New Zealand, and real estate in stable jurisdictions like London, Vancouver, or Dubai. These structures are complex and expensive to establish and maintain, requiring sophisticated legal and tax advice, but they provide protection and flexibility that domestic-only asset holdings cannot match. For ordinary people, this international diversification is largely unavailable. Most can't afford offshore accounts that require minimum balances of hundreds of thousands or millions. They can't navigate the legal complexity of offshore trusts and international tax reporting, and they lack the wealth to justify the costs of these structures. But the wealthy use them routinely, ensuring that no single government's policies can destroy their entire wealth. The fifth mechanism is using sophisticated entity structures that provide liability protection, tax benefits, and operational flexibility. The wealthy rarely own assets personally. They use corporations, limited liability companies, partnerships, trusts, and other entities that separate personal liability from asset ownership, provide tax benefits through deductions and deferrals, and allow wealth transfer strategies that minimize estate taxes. A real estate investor might own properties through multiple single-asset LLCs, each holding one property. This provides liability protection so that if one property faces a lawsuit, only that property's LLC is at risk, not the investor's entire portfolio. The LLC structure also allows for sophisticated tax strategies like cost segregation that accelerates, depreciation deductions, and like-kind exchanges under Section 131 that defer capital gains tax when selling one property and buying another. Family limited partnerships, or family LLCs, allow wealthy families to transfer wealth to younger generations while maintaining control and taking valuation discounts that reduce gift and estate taxes. A parent might transfer 30% of a family business to children through a family limited partnership, valuing that 30% at a substantial discount from 30% of the business's total value because it's a minority interest without control. This allows more wealth to transfer tax-free within estate and gift tax exemptions. Irrevocable trusts remove assets from the grantor's taxable estate while providing benefits to beneficiaries, allowing substantial wealth transfer without estate tax. Charitable trusts provide income during the grantor's lifetime and donate remaining assets to charity upon death, offering tax deductions and estate tax benefits while supporting causes the grantor values. These structures require sophisticated legal and tax advice and have establishment and maintenance costs that make them practical only for substantial wealth. But they provide enormous benefits to those who use them, further separating the wealthy who can access these tools from ordinary people who own assets in their own names and face full exposure to liability and taxation. The sixth mechanism is fee awareness and optimization that seems minor but compounds significantly over time. The wealthy typically pay far lower investment fees as a percentage of assets than ordinary investors. Someone with $100,000 in a typical actively managed mutual fund might pay 1 to 1.5% in annual fees, costing $1,150 annually, and much more over decades as those fees compound. Over 30 years at 7% returns, $100,000 compounds to $761,000 with zero fees, $566,000 with 1% annual fees, a difference of $195,000 or 26% from fees alone. The wealthy access institutional share classes with fees of 1.1 to 0.3%, private placements with lower fees than retail products, direct investments without intermediary costs, and negotiate fees when paying advisors. They might pay 0.5% on a $10 million portfolio, $50,000 annually, which sounds like a lot but is half the percentage cost that the middle-class investor pays. And because fees compound against you, the difference compounds to millions over a lifetime. Similarly, the wealthy avoid high-interest consumer debt that traps ordinary people. Credit card rates of 20-30% are devastating to wealth accumulation. A family carrying $10,000 in credit card debt at 22% interest pays $2,200 annually just on interest, money that should be compounding in investments instead. The wealthy use credit strategically for leverage at low rates, but avoid consumer debt that destroys wealth. The seventh mechanism is time horizon and discipline to hold through volatility. The wealthy can afford to ride out market crashes because they have sufficient liquidity to weather years without needing to sell assets. A retiree with modest savings who needs to sell stocks to pay living expenses during a market crash realizes losses and permanently impairs the portfolio. A wealthy investor with substantial cash reserves can hold through the crash and let the portfolio recover, avoiding realized losses. This time, horizon advantage compounds because it allows the wealthy to be net buyers during crashes when assets are cheap. As detailed in the previous script on how the rich profit from recessions, distressed sellers liquidating during crises transfer wealth to patient buyers with long time horizons. The wealthy can wait decades for investments to mature, holding real estate through multiple cycles, keeping stock positions through bear markets, and investing in illiquid private equity that locks capital for years but generates superior returns. The eighth mechanism is access to investment opportunities unavailable to ordinary investors. Private equity, venture capital, hedge funds, and direct investments in private companies typically require accredited investor status and minimum investments of hundreds of thousands or millions. These investments historically generate higher returns than public markets, though with higher risk and illiquidity. Someone with $50,000 to invest can access public stocks and bonds, but can't invest in the venture capital fund that backs the next tech unicorn or the private equity fund that buys companies and restructures them for profit. The wealthy can, and they generate substantial returns from these alternatives that help compound wealth faster than conventional investments allow. The regulatory structure that restricts these investments to accredited investors is supposedly for protection, ensuring that only sophisticated investors with resources to absorb losses can access risky alternative investments. But the effect is to reserve the highest return investment opportunities for those who are already wealthy while restricting ordinary investors to lower return public markets. The ninth mechanism is family office infrastructure that provides professional wealth management, tax optimization, legal services, and coordination across all the strategies mentioned above. A family office is essentially a private company that manages a single family's wealth, employing investment professionals, accountants, lawyers, and other specialists who work full-time optimizing the family's financial affairs. This infrastructure allows the wealthy to implement strategies like buy, borrow, die, maintain offshore structures, harvest tax losses, time capital gains recognition, use charitable vehicles strategically, and generally manage finances as a professional operation rather than as individuals making decisions in spare time with limited expertise. The costs are substantial, often requiring $50 or $100 million in assets to justify a dedicated family office, but the tax savings and return optimization from professional management far exceed the costs. Compare this to an ordinary household where the wage earners work full-time in their careers, manage finances in spare time with limited knowledge, use retail investment products with high fees, and rely on free advice from commission-driven salespeople or pay hourly for occasional consultation with advisors. The wealthy have teams of professionals optimizing every financial decision. The difference in outcomes compounds dramatically over decades. The 10th and perhaps most important mechanism is mindset and financial education that treats wealth building as a primary focus deserving significant time and resources rather than as something to address casually or delegate to financial salespeople. The wealthy study markets, understand economics, network with other successful investors, and continuously educate themselves about opportunities and strategies. This knowledge allows them to recognize opportunities others miss, avoid pitfalls that trap the unsophisticated, and make strategic decisions that compound over time. They also teach their children about money, investing, and business from young ages, providing education and early experience that creates generational advantages. A child who understands equity ownership, compound returns, and tax optimization by age 15 has decades to implement those strategies. A child never taught these concepts spends adulthood learning through mistakes and starts serious wealth building, if at all, in their 30s or 40s after wasting decades. The tragic aspect of the money trap is that it's designed to be nearly inescapable for those born without wealth or connections. The financial advice given to ordinary people, save prudently in bank accounts, invest in your 401k with high-fee mutual funds, buy a home with a 30-year mortgage, work hard and be loyal to your employer, is almost perfectly designed to ensure they never build significant wealth while believing they're doing everything right. They save in cash and watch inflation destroy it. They earn wages taxed at the highest rates. They invest through high-fee intermediaries that capture much of their returns. They buy a home, often the largest purchase of their lives, with 30 years of interest payments at fixed rates, while the home's value may or may not keep pace with inflation. They work for wages that might not keep pace with inflation, while business owners and investors capture the real wealth creation. And they're told this is responsible financial behavior, the American dream, the path to middle-class security. Meanwhile, the wealthy follow completely different rules. They borrow at rates below inflation and invest the proceeds in appreciating assets, being paid to leverage. They structure income as capital gains taxed at half the rate. They never realize gains, borrowing against assets and passing them to heirs with stepped-up basis that eliminates tax liability. They diversify internationally so no single government can confiscate wealth. They use entities and trusts that provide protection and tax benefits. They access investment opportunities with superior returns. They employ professionals to optimize every financial decision, and they teach their children these strategies from young ages. The system isn't just unfair. It's deliberately structured to perpetuate inequality by providing escape routes accessible primarily to those who already have wealth while trapping everyone else in financial strategies designed to transfer their wealth upward through inflation, taxation, and fee extraction. Breaking out of the money trap requires recognizing it exists and implementing some version of the strategies the wealthy use, scaled to whatever resources you have. Hold minimal cash beyond emergency funds. Invest in appreciating assets, even if it's just index funds rather than real estate empires. Understand tax optimization strategies like tax loss harvesting and Roth conversions. Use low-cost index funds rather than high-fee active funds. Learn about money and investing continuously rather than delegating to salespeople. And most importantly, think like an owner rather than an employee, building equity in assets you own rather than trading all your time for wages. These strategies won't make you a billionaire if you're starting from nothing, but they can allow you to avoid the worst of the money trap and build real wealth over decades rather than running in place while inflation and fees destroy your purchasing power. The wealthy have proven that following conventional wisdom about prudent saving and responsible financial behavior is the surest path to staying poor. Their behavior reveals the real rules. Own appreciating assets, use debt strategically, minimize taxes through legal strategies, never hold significant cash, diversify internationally, use sophisticated structures and professional advice, maintain long-time horizons, and teach your children to do the same. Understanding how the rich escape the money trap means recognizing that financial freedom doesn't come from working hard and saving prudently in a system designed to exploit those behaviors. It comes from learning and implementing the strategies the wealthy use, even on a smaller scale, and refusing to follow financial advice designed to keep you trapped while enriching those who provide it. The trap is real. The escape routes exist. Whether you'll find them and use them or spend your life believing you're being financially responsible while actually guaranteeing you'll never build wealth is the choice that determines whether you escape or remain trapped in the game everyone else is losing. If this gave you a new perspective, hit subscribe. The money trap has caught hundreds of millions in its jaws, convincing them that saving cash is prudent while inflation destroys it, that working for wages is honorable while the tax code punishes labor and rewards capital, that investing in high-fee products is responsible while fees compound against them, that following conventional wisdom is safe while that wisdom was designed by and for those who profit from your financial ignorance. The wealthy escaped long ago. They hold assets not cash, structure income for favorable tax treatment, use leverage strategically, diversify globally, employ professionals to optimize everything, and laugh at the conventional wisdom they'd never follow themselves. The rules they play by are completely different from the rules you're told to follow. And until you learn their rules, adopt their strategies, and stop believing that the financial advice given to ordinary people will make you anything but ordinary, you'll remain trapped in the game designed to transfer your wealth to those who already have it. Working until you're old, saving prudently while inflation destroys your purchasing power, paying the highest taxes on earned income while the wealthy pay half that on capital gains, and retiring on far less than you deserve after a lifetime of doing everything you were told was right. But that was actually perfectly designed to keep you poor while calling it responsibility.